So it feels like the dollar was a detriment to the manufacturing base in the US and maybe more blue collar workers, whereas it really raised up the living standards and opportunity in the rest of the world.
That was just because we had labor and wages that had gotten so far out of balance with the rest of the world, because you have basically subsistence wage populations all over the place, that if you're running a company, I mean, it makes perfect sense why you would do that. Now, again, we've seen these economic transformations all throughout history. When we transformed from an agrarian society to an industrial society, a lot of agrarian workers were thrown out of work. They had no place to go. So they migrated into the factories where new jobs were awaiting for them. The problem with the Eurodollar system is that we didn't have the other half of that transformation. So as blue collar jobs were shipped off to Asia, what was waiting for everybody in those blue collar states? Finance. We had too much, we had stock market. We had residential real estate. Those are not jobs that we can replace blue collar jobs. You can't transform from an industrial based society to one based on asset bubbles. So that was the primary problem. That's what really, in terms of the labor market, came to a head in the decade of the 2000s, is that we eroded the manufacturing base and basically papered it over with too much finance.
Do you think there's a risk of doing the same now with the dollar so strong?
Well, yeah. I mean, why is the dollar strong though? The dollar is strong because there's a shortage of dollars around the world. There's a massive shortage. There's so much shortage of dollars around the world. To your first point, it's becoming a problem in London. London used to be the center of the monetary, economic, and commercial universe. Even in the Eurodollar system, the Eurodollar was primarily based in the city of London. So for the fact that these Eurodollar issues, these dollar shortages coming home to London, there's some alarm bells here going off.
I think there'll be people listening that will know how much money the US have printed over the last few years and be like, how the fuck is there a shortage? So can you explain what that shortage actually means?
The shortage actually means that the Federal Reserve, the federal government don't print money. Money printing, money creation is the responsibility of the banks operating this global monetary system. It's no different than a fractional reserve system. Banks create money through credit creation, except they don't do it in the same ways because in the Eurodollar system, there is no reserve to fraction. It's essentially balance sheet mechanics. I don't know how far you want to get into the details there.
We want details.
It's essentially based on a lot of mathematics, modeling, VAR, Vega. If you're running a bank, how much credit you create is based on risk perceptions, present value calculations. It's all math. It's all about derivatives. It's all about these kinds of deep financial inputs that allow commercial banks to either expand their balance sheet or force them to contract. And what we've seen since August 9th of 2007 is banks have been forced to contract. So they're contracting money and they're contracting credit, and they have been pretty much continuously. And when I say contract, let me be specific here. I don't mean shrinking. I mean growing at a different rate.
Okay.
We live in a nonlinear world, which means that if we were growing at, say, 10% per year, and all of a sudden you're growing at 5% per year, that's a massive contraction, especially if you spread that out over 15 years. That's a huge, enormous contraction. So it's not like we're actually shrinking the pile of banks, although a lot of banks have gotten smaller. But by and large, the credit system globally used to grow rapidly, and now it's kind of just piddling along. And because it's kind of piddling along, we don't have enough money around the rest of the world. What happens? Governments try to fill in the gap. How do governments try to fill in that monetary gap? Well, they do what they do, which means they knock on the door of the central banker and say, hey, isn't this a money issue? And the central banker says, we don't do money, but we'll do something because we have to. And so what have central banks been doing over the last 15 years? Quantitative easing. So people think central banks have been filling the gap with bank reserves, when bank reserves don't really have much of a role in the Eurodollar system. So you have this persistent dollar shortage that nobody knows about, and these governments, the persistent need for central banks and governments to do something about it, which everybody does. It leads to this confusion where we have disinflation or deflationary money globally, but everybody thinks monetary system has exploded.
How does a dollar shortage show up? What is when you say there's a dollar shortage globally, I'm like, if I need dollars, I can get dollars. What do you mean in terms of the kind of like the mechanics of the economic system?
It's the same as anything else. The price of dollars goes up. It's much more inflexible.
No, I mean, how does the shortage, when you say there's a shortage, what is the situations where people need dollars and they can't get it?
You can still get them, but you have to pay a much higher premium for them. So
is that companies needing it for trade because the dollar is the global currency, and if they want to make a certain trade, they need those dollars?
Absolutely, everybody. That's the thing. That's what a global reserve currency is.
So where do they traditionally get those dollars from, and why is there a shortage now?
Traditionally, what happens is you have local companies transact with local banks.
Yep.
The local banks will act in the eurodollar market to secure dollars, usually in short-term funding arrangements. So what happens is you have a maturity mismatch between the local bank borrowing in short-term money markets in the eurodollar system, but lending in longer-term credit to corporations who have to do things. So for China, for example, you're a Chinese company, you're importing a lot of raw materials, and you're exporting a lot of finished goods. So you would think that the Chinese have tons of dollars because they export more than they import, which should be the case. But there's all sorts of stuff that happens in between where the exporters are not the importers anyway. So you're an importer in China. You want to bring raw materials from, say, Brazil or whatever. You have to have dollars to do that because the Brazilians don't want yuan, and there's no other reserve currency that's flexible in both places. So the Chinese company has to borrow dollars from somewhere. They get them from a local Chinese bank, which is usually one of the big four behemoths, the commercial banks in China. And the commercial banks in China, where do they get their dollars from? From the eurodollar system. So they're constantly borrowing largely from banks in Tokyo, who also borrow dollars from banks all over the rest of the world. So you have this constant recycling and redistribution of money through the banking system that eventually finds its way into some corporate hands.
If they're going into the eurodollar system to get dollars and they're borrowing from the banks, do the banks have to have those dollars, or does this comes down? So it comes down to the rules of how much they can make up.
let's say we have two different companies in China. One is a big company that everybody knows. One's a little bit smaller that nobody does. It's the old argument between the big company and the small mom and pop. So in this instance, what we have is the big company can get all the credit it wants because it's a big company. And in times of risk aversion, where you're a eurodollar bank that usually redistributes or lends eurodollars freely, if you're risk averse, the mathematics, the volatility, all the stuff that goes into your balance sheet says you need to pull back a little bit. Who are you going to lend to? You're going to lend to the big Chinese firm or the big Chinese bank who will lend to the big Chinese firm on much more favorable terms than you will the smaller bank or the smaller firm. So what happens is for the big bank, they can borrow as much, or the big bank or the big company, they can borrow as much as they need to. The smaller and medium-term businesses don't fit the risk profiles of these large banks and the eurodollar businesses, so they're the ones that get deprived of credit. Now, they can still obtain credit. They can still obtain dollar lending, but it's on much more onerous terms, which means it becomes a drag on commercial activity, which is the exact thing that we don't want to have happen for a global reserve. It's more complicated. We're being very stylized here, but essentially that's what happens, which is why you hear governments and central banks around the world constantly complain about credit resource allocation to SMEs, small and medium-sized enterprises. They're the ones who can't get credit because we have a global monetary and credit shortage.
So as the global economy expands, and if it expands rapidly, does that mean there's a need for the dollar to expand rapidly?
There needs to be a dynamic match between supply and demand.
Right.
And that's really where traditionally the gold standard goes off the rails, is because under a constrained system, what happens is human beings, human ingenuity will find other ways around that monetary restraint, which usually leads to all sorts of quasi-money that becomes bubbly, gets overdone, and you lead to this boom-bust cycle. Okay,
so in the current scenario, there is a shortage of dollars, and that is down because the European banks, the banks outside, the banks outside of the US, they don't have enough dollars to lend?
They don't have enough balance sheet capacity to create the money and credit that the global economy needs. So we have...
How do they create more balance sheet capacity?
Again, it's the mathematics. It's capital ratios. It's balance sheet metrics. It's all this internal black box stuff that we have no idea what goes on. So we have to sort of look at the whole, because we can't observe what banks are actually doing. We don't know what banks are doing on any given day, but financial markets tell us basically what's happening because we can kind of tell what's going on.
But does each bank set its own rules?
Yes.
So it's because these banks have created their own set of rules, and okay, I get it. Right. So it says to me that ideally these banks would be taking on more risk.
Yes, that was the inherent problem, though. The pre-crisis system required banks to do a lot of stupid stuff in order to create enough credit and money, actually create too much credit and money in the pre-crisis era. And in the post-crisis era, and seeing what happened, Bear Stearns, AIG, Lehman Brothers, that there's a downside to all that, because that was a big belief that supported balance sheet expansion, right? Because we had recency bias and all these black box models that said, you can take all the risk you want, the downside is very small, very thin. And then we realized that wasn't true. Now we know that the downside is real. In fact, the downside is so real, it caused some of the oldest, most well-known names on Wall Street to essentially get thrown out of business, insolvent and bankrupt. There is a tremendous downside. The very way balance sheets are run in the post-crisis era is very different from beforehand, not just the mathematics, but even the human processes. If you wanted to expand your book, your mandate in a bank before the crisis, you basically just went to a boss and said, I have this idea. It's crazy. It's stupid, but we can make money. And the boss would say, go ahead and do it. You could come up with any exotic derivative transaction you wanted to, and you were likely to get approved, which had the effect of your client was happy, your balance sheet was expanded, everybody seemed to be making a lot of money. Nowadays, you can't do that. You've got to go through risk committees. You got to go through different layers of compliance. Banks are run very differently. Their balance sheets are run very differently because obvious reasons.
And they don't have the same happen again.
And that's not regulation. That's just
the
regulation
risk tolerance came along afterwards.
Right.
So banks already started redoing their balance sheets from the very moment that the system broke down in August of 2007, then accelerated their transformation in March of 2008 when Bear Stearns kind of put the exclamation point on the whole thing. But the thing is, go back to your original question, the global economy needed monetary and credit resources in order to continue to expand and globalize. But now we have a system where that was foolish, but we never replaced that with anything. So we have this malfunctioning system that doesn't produce enough credit because banks won't expand their balance sheets. And then, to your point, regulations have come along afterwards and made it even more expensive, made it even more difficult to expand your balance sheet. So what do banks have done? Kind of logically, they hold the safest liquid assets. They only lend to the safest, most liquid credits. Everybody else has to go wait in line.
But the implication of that there's multiple implications, but for the US means a strong pound, which means I say yours because you're an American and I'm not, your balance of trade changes. But it also has implications on the rest of the world in that, a strong dollar causes deflationary pressures on smaller nations. I mean, I'm repeating something Kathy Wood said to me about half an hour ago, rather than just being super smart. But I'm understanding those pressures, and
those pressures are just the other side of the dollar shortage.
Yes, but how do they? What is the ways that this dollar shortage can be dealt with? If the banks outside of the US aren't willing to lend more, does the Fed have to step in here? Do they have to provide the liquidity?
How?
You tell me.
They don't. They can't. That's the issue. That's why, you see the Fed constantly evolving its tactics. First it was back in, 2006 and 2007, Mr. Subprime is contained, said, no big deal. What was the first thing the Fed did? They lowered interest rates. Did that help? Of course it did. So then they constantly had to evolve. What came after lower interest rates? There were TAF auctions and overseas dollar swaps. So that was a tacit admission right then in December of 2007, we have a global dollar problem. Why is the Fed instituting dollar swaps with foreign central banks?
So is that swap lines?
Yes.
And is that, so I've heard that described as like QE for other countries.
It's just as worthless and ineffective, yes.
But how does it actually work? I've never understood that.
The Fed essentially institutes a swap line with a foreign central bank because it has no legal authority to transact with anybody outside the U.S. boundary, except for foreign governments. So what happens is the Fed does a dollar swap with a foreign central bank, say the ECB. So the Fed and the ECB agree on the terms of the swap immediately, which means the Fed gets euros on its balance sheet, and the ECB gets dollars on its balance sheet based on the equal exchange value.
Right.
And then the ECB auctions those dollars to its local banks.
So that would presumably, in their mind, adds liquidity, but you don't think it does.
It only reaches the largest banks. And then a lot of the banks that bid for those overseas dollar swaps, so it's not a European bank at the ECB getting dollars from the ECB. It's usually a foreign subsidiary of a U.S. bank buying dollars at the ECB and then transferring them back to the parent in the U.S. to be redistributed at huge premiums to everybody else. It's essentially a money-making scam that allows the largest banks to get as much liquidity as they want. Balance sheet free doesn't affect their balance sheet numbers whatsoever because they can charge huge premiums to everybody else that is short of dollars. So it's another one of those things that people say, the Fed is doing this, it's overseas, it must be like QE, it's money printing. When in fact, it's a lot more complicated at the very least. And when you actually see what happens, you can see why it's actually not helpful. So again, back to my point, the Fed constantly has to evolve tactics because none of the things they do actually work. So after we had the TAF and dollar swaps in December 2007, we had something called the Primary Dealer Credit Facility. That didn't do much because then that led to Bear Stearns, or that came after Bear Stearns, that led to Lehman Brothers and AIG. Then we had a whole bunch of alphabet initialisms come in late 2008. Did those work? We had overseas dollar swaps that went to $600 billion almost during the worst financial panic since the Great Depression. Did they work? They couldn't have. They couldn't have because we had the panic anyway. So the Fed constantly evolves these tactics because it can never solve the big issue, which is balance sheet constraint of all these global banks that used to create dollars freely who can no longer do so for various reasons.